Hello traders, this is the part 3 of the daily bias algorithm series. In previous videos, I introduced you guys to the bias algorithm that I built into a profitable private EA or trading bot that I'm currently using for my trading. In this video, I am going to be focusing on how you can combine everything you've learned so far with my free TradingView indicator to frame high probability entries and targets, and I'm going to show you a lot of examples from recent price action. The indicator is what you can currently see on my chart, showing a sell here and a buy here. If you do not already have access to it, there is a link I added to the description section of this video with instructions on how you can get it. Okay, it's completely free, but it's not available on the public TradingView indicator directory, so you can't just come here to add it to your chart. Okay, you have to click on the link that I dropped in my Telegram channel. There is a link. The link I drop in the description section should lead you to my Telegram channel and straight to the specific post where that contain the link to the indicator. So just click on the indicator and follow the instruction that had been provided. Okay, without wasting more time, let's get into the business of the day. Remember from the first video, I explained to you guys the concepts of the new week opening gap and how it can be used to frame high probability trade bias. Okay, we have a few examples there. Remember I mentioned that if there is a close above a new week opening gap and if we get a return into it, the first return into that new week opening gap will not close below it. So once price gets to that new week opening gap or it is below it, you would be looking for long. So that means your bias is going to be bullish and it's going to remain bullish until price return into a new week opening gap that price has not yet returned back into after a change in state. Okay, change in state is when a previously bullish new week opening gap turns bearish when there is a close below it, and if the new week opening gap is initially bullish, if it is initially bearish and there is a close above it, that new week opening gap is going to become bullish. Okay, so very simple stuff. If there is a close above a new week opening gap, it becomes bullish. The first return into that new week opening gap will not close below it. Okay, typically there is a 90% probability it wouldn't close below it, and vice versa for the for bearish scenario. So if there is a close below a new week opening gap, like we have here, this is a new week opening gap, this guy closed below it, this is the first return into it, while price is rallying into and above that new week opening gap, your bias is going to be bearish. You are going to be looking for a sell. Okay, so I believe that is pretty simple, that is pretty straightforward. And in the last video I explained that on the daily, what you look for on the daily to frame your bias, I explained that if the current day's low is below the previous day's low and the current price, which is the price at which your setup is formed, the price at which you got confirmation for an entry, if that price is above the previous day's low, then your bias is going to be bullish. That is what we have right here. Okay, so let's say you had a buy on this day, buy setup on this day, and you look at the price at which you got your setup. If that price is above the previous day's low and the current day's low is below the previous day's low, your bias will be bullish, right? And the opposite of it is what you can see here. If the current day is above the previous day's high and price at which you got your setup, or at which you got confirmation for your setup, whichever entry technique you are using. The price at which you got your setup is the current price. Okay, so that current price, if it is below the previous day's high and the current day's high is above the previous day's high, your bias is going to be bearish. So you can see that happening right here, right here, right here. So these things can also see it happening right here as well, and right here as well. So it repeats week in, week out. You can get at least 2 to 3 setups simply based on that daily approach every single week. Okay, but you know, I repeated multiple times in last week's video that you are not going to use it in isolation. Okay, so you combine it with the weekly approach that involves the new week opening gap. Okay, so the essence of this video is to provide a lot of examples and show you from recent price action and show you exactly how you could have used the Tradingview indicator to take an entry on low time frame. Okay, so I'm going to go back to the weekly, and let me open another chart. Okay, let me open another chart here, and this one would be on the low time frame. I'll use the 5 minutes. I'll use I'll use the weekly here, and I'll use 5 minutes on these charts. Okay, so I have the 5 minutes time frame here, and I have the weekly here, and I think I would need a daily. Okay, let's just leave the daily approach for now. Let's work primarily with the weekly, and then on low time frame we should be able to see what the daily is doing easily. Okay, so what I'm going to do, I'm going to use the replay button. I'm going to go back to this week. This is week 1, 2, 3, 4. Tradingview only provides data as far back as about a month on the low time frame. So on this 5 minute time frame, I can only go back as far back as 1 month. This is 6th, today is 6th, today is 2nd. So I should be able to see price action. Okay, let me put it on first, go back in time. This is what? This is 5. Okay, so this is 5th. You can see I can see data before this time. Okay, so this is 6th. This is Monday 6th. So that means I can only show you examples from here up onto the current price action. So what I'm going to do is I'm going to use the replay tool to go back to this day. So assuming we haven't seen this, so we're going to take each week one after the other till we cover the whole week. Okay, so we're going to assume that we don't know what price is going to do. Like, this is the week you want to do your analysis. What do you look at? How do you build a bias? Okay, based on what you have learned so far, and how do you actually take an entry on low time frame? Okay, so remember, the first thing you want to look at is weekly. Okay, is weekly. Okay, so the first thing is you want to mark out your new week opening gap. Okay, this is the most recent new week opening gap, right, on this day. Okay, but this is extremely small, but you could mark it out. That's pretty much what you want to do. At least you want to mark out the first one that forms that week. Okay, it's very tiny, but it doesn't mean it is not valid. Okay, however, would you expect that price will come all the way, drop all the way to return into this area? Perhaps not. But the best thing to do is to mark out the closest new week opening gap that had recently turned bullish. Okay, so what you want to do, I explained in the first video, what you want to do, you want to go back in time until you find a new week opening gap that has recently had a change in states. Okay, remember I explained that a change in states of a new week opening gap is when a new week opening gap that was initially bearish in the sense that when it formed, the weekly candle that formed it closed below it. Okay, for example, here this is the week that formed this new week opening gap, right? It closed below it, so that new week opening gap is confirmed initially bearish. Okay, now if let's say price should go back up and close back above this guy, this new week opening gap is said to have experienced a change in states from what bearish to bullish. So I just say I should record just for the sake of those that are probably seeing this video for the first time, okay, or seeing this series for the first time. All right, so what you want to do is you want to go back in time, okay, and you want to look for a new week opening gap that was previously bearish but has now turned bullish this week. Okay, so let's check. You can see up until this, all of here, we have a lot of new week opening gap here, but there was no recent close above it. Okay, this is a new week opening gap. Price has closed above it. You're going to mark it, but we want to check, is this the closest to the current price action? The current price action is going to be the close of the previous week. We're starting a new week. You want to mark out your chart. You want to build a bias of what you expect. Okay, so you want to look for the closest to that close, this current close. Okay, if we go back in time, this is a new week opening gap, but this did not close above it. So all the new week opening gap here are not valid until you get here. Okay, this is the closest new week opening gap to the current price action that has recently had a change in states. Okay, so if I should mark these out, extend it out in time to 300 maybe. Okay, so let me extend it more. Okay, so extend it out in time. You know that this new week opening gap, after this, the closest is probably right between this week and this week, but it's very tiny, but it's right there, and it does also mean that it is not valid. Okay, if you extend this out in time, you see that this week price has already closed above it, and we've gotten a return into it this week, and you can see how price did not close below it. So even if you did not use this guy, you can as well use this one right here. Okay, and there is also another one. This is also another one here. This is a new week opening gap right here. Okay, if we extend this out in time, price has also closed above it. Price has closed above this guy here. After we got the close above it, okay, we've not gotten a return into it. So this is new, this is fresh. That is, we've not gotten a redelivery into these two new week opening gap. This guy right here, this guy right here, and yeah, so those are the closest to it. 1, 2, 3. So what will be your expectation if at the start of the week, okay, you want to anticipate a return? Remember I mentioned also from the first video that there is a 70% probability that the first return into a new week opening gap after a change in state. Okay, there was a change in state of this guy, there was a change in state of this guy, and for this guy, this is the first formation of this new week opening gap, and there had never been a return into it. Okay, so you know that at the start of the week you would anticipate a return into this new week opening gap. or this or this. You don't know how far down price is going to go. Okay, you don't know, but one way you can determine which to use, I explained that also in last video, is to find a range. Just draw your fib to find the equilibrium of the previous week. This is the equilibrium of the previous week, right? So below equilibrium is discount, above equilibrium is premium. Okay, so you know that all of these new week opening gap, this and this, they are all valid. Okay, so the algo can frame its price action around any of these three. All of it are valid. Okay, so just use any one. Okay, so I'm going to use the first one. So generally just use the closest one. Okay, the closest one that is at discount is what you should use. Okay, now there are instances when price may not even drop into discount, but don't let me confuse you. I don't want to focus on that for now, but what I'm trying to explain here is the first thing you want to do: mark out your new week opening gap. We've done that. Then if you have multiple new week opening gap, you can see here and here, we've already closed above all of them, so we're anticipating a return into one or all of them. Okay, so which one do you use? First, you want to make sure there is, you want to make sure they are all valid. Okay, by what? By finding the equilibrium between the high and the low of the previous week, and is only new week opening gap that are below equilibrium, that is the ones that are discounts that you frame a long on. Okay, once you've done that, we've seen that this is valid, this is valid, this is valid. The next thing you want to do is to look for potential targets. Okay, that is what, if the bias is bullish, okay, if the algorithm is in a buy program, that is what it will reach for. So you want to look for new week opening gap that are turned bearish but price have not yet returned into. Okay, so we've marked the ones that are below. Now I want to mark the new week opening gap that are bearish. So that is what you want to use as your potential target. So let's do that. We have a new week opening gap here. Okay, but you can see that price has already returned into it, right? This is the first return. You can also see how price did not close above it. Okay, here we had a close below it. Here, this is extended out in time. This is a close below it. After we had this close below, this change in state of this new week opening gap, this is the first return into it. Okay, so remember I mentioned there is a 90% probability that the first return will not close above it, and there is a 70% probability that the second return will not close below it. The third return is 50-50. Okay, so you could target this new week opening gap, or you look for a fresh one that price has not returned into after a change in state. So if we keep checking, this is a new week opening gap. It's very tiny, but it is also still valid, so you could use that as well. Or this is one that is very obvious. After, let me mark it out here. Right there. Okay, so we see this new week opening gap. This is where it formed. Price closed below it here. That was a change in states. Price rallied above it, failed to close above it, and then after, on this week, you can see that here there was a change in states. Price closed above it here, and then there was another change in states the following week. This is CPI, right? So we've had a close back below, so there was a change in states, and after this change in states on this week, we haven't yet gotten a return to it. Okay, so you are going to mark it out. Okay, so you could use this as targets, or you could use this as targets. Okay, but personally I like to frame my shorts on a fresh one that price has never returned into, but I could still use the second return as target. Okay, this is the first return, so I could still use this as target. But since I know that, if price should come here, there is a good chance it is going to come here. Okay, remember, there is a 70% probability that after a change in states, the algorithm would typically drive price back into that new week opening gap. So for this week, what I will be anticipating is, at the opener of the week, I'll be anticipating a drop into this guy, and once price gets to this guy, my bias is going to turn bullish. So I could be bearish until price gets here. Personally, I don't like to do that, right? I prefer to wait and not do anything until price gets here, and then I'll take a long to target this guy and the high of this fresh guy right there, and then I'll start looking for a short. That would be my expectation or anticipation going into the week. Okay, so or that is one scenario. The second scenario is I could anticipate that price is going to rally up to take out this high and then reject from here to come back into this area. That is another scenario. That is if maybe I'm anticipating a reversal, but I don't like to predict what price is going to do. I just build like a kind of if then this is what I would do. Okay, so basically those are the two scenarios I will have in my mind going into the week. Okay, so it is okay if you try to because you can see that the order flow is currently bullish. You can see price has been closing above new week opening gap, close above this guy here, price returning to this, close above, price returning to this, close above. So it's clear and obvious that the current order flow is bullish. So what is more appropriate or what is more likely is a return into this new week opening gap, or probably down to this or this, to continue forward, to continue higher into this guy. So that is the narrative I am going to have in mind going into the week. Okay, so let's see what the market has done that week. Okay, I think that should be the okay. So let me so we see the weekly bar. We don't know exactly what happened, right? We don't know if price actually came here first and then dropped down and then closed higher, or it dropped down first and then came here and then closed here. Okay, we don't know. Okay, so let's go into the low time frame, but I'm most likely almost certain that this is probably going to be a drop into this area and then a continuation higher. Now there are other things that that you could use to know that it's not going to come here and it's not going to come here, but I don't want to delve into that in this video. But basically there are ways to know when you should expect that price should come to the lower ones you've marked out, okay, and when you think price should do that. Okay, let me just cover it briefly. What you do is you look at balanced price range. Okay, here's your rule. If there is a range in price and that range in price is balanced, okay, typically the algorithm would not allow a return into that area until it reaches its target. Okay, in this case, this is pretty much what the the algorithm is likely going to be driving for, because after this change in states, we haven't there haven't been a return back into it. So typically, if you have a ranging price, an important ranging price, not just any ranging price, you can define your ranging price using fair value gaps, even order blocks, liquidity void, vacuum block. But the easiest one you can use, and the one that is noticeably visible, is the fair value gap. Okay, you can see from here, this is a fair value gap between the low of this candle and the high of this candle. All right, that's a fair value gap. Right here, you can see that I already even marked it out on my chart, because on this week I actually traded these and I wasn't expecting price to come into this area, because it's a balanced price range. Now, what is a balanced price range? A balanced price range is a range, an important range in price that price has passed through 3 times, and 2 of those 3 times buy side was delivered and sell side was delivered. That is, price has rallied through it, dropped down below it, and then moved away from it. Okay, which is what happened here. You can see we had a rally here, that is buy side provision, and then we dropped back down, that is sell side provision, and then we moved away from it and closed above that range in price. So you can see how price came back, touched the low of that new week opening gap, and reversed. So that was exactly what I was anticipating at the start of the week. Okay, I was looking to see if we would actually completely return to the low of this new week opening gap we marked out, right? But it's it's bounced from the middle of the new week opening gap. So let's go to the low time frame and actually see how you could have taken an entry. Okay, this is a low time frame. Okay, so this is Monday 6th. Okay, so the week started Monday 6th, right? So on the first Monday we had a rally into that, this is that second return into, that's this guy. So that means the first thing we saw on Monday was a rally into this guy, and then we had a rejection there. So that means we first had a rally and then a rejection back into this area, and then we closed up here. So the first thing we had is a buy. Remember that this is the indicator, right? This is the Tradingview indicator. First, let me give you a set of rules to follow when using this indicator. First things first, buy and sell signals that form outside the Q zone are mostly not valid. At least 90% of those signals would most likely lead to a loss. Okay, you're gonna get stopped out, right? So you want to take signals that form only during the Q zone. So I've marked out the Q zone here between now 5 to 7 a.m. is not part of it. Okay, it's only from 2 a.m. New York time to 5 a.m. New York time, or 7 a.m. New York time to 12 is somewhere here, 12 New York time. So that means this buy, it's best to just leave it. Remember, our expectation for the week is we want to say drop into this new week opening gap to take a long, okay? Or we could also take a short at the start of the week to come into this area before we then close our short, and then we take a long, right? So that means all of this buy, we are not going to take it. Okay, so the moment price gets in here, remember there is a 70% probability that the second return into a new week opening gap, this is the first return, this is the second return, will typically not close above it. Okay, look at the close of the candle. You can see even on the 5 minutes, down to the 5 minutes, there was no close above. You can see that the close of the This guy is exactly the high of the new week opening gap. This stuff, these things I am teaching you is algorithmic. Okay, this is algorithmic signatures, right? You can see how that 5 minutes, even though we are dealing with a weekly gap, you can see how even the 5 minute time frame did not close above it. Okay, so while price is here, you can be looking to frame along. You can see how here we had a change in states of delivery right here. Moment I'm already talking about something else. Anyway, there is an entry you could have taken here if you understand CISD using other blocks. Okay, but I want to limit myself to just the indicator. Okay, if you have other entry techniques, you can, and your setup presents itself after price has tapped into this, you can maybe take a short and then you target the new week opening gap that we are anticipating that price should drop into, which is, this is the first one, this is the second one, and this is the third one. Okay, so let's assume you don't even understand anything, you don't know anything about balanced price range. Okay, just, you know, any setup that formed immediately price touches this area, you want to go long. Okay, so let's go back to here. So on Monday we had a short set. This is outside the Q zone, so no trade on Monday. Okay, all of this buy won't be valid because it is against our buyers. Okay, remember our buyers is bullish, but it is not going to be bullish until price actually gets to that new week opening gap. Okay, however, you can be bearish until it gets to it. Okay, it is not as high probability as waiting for price to get to it and then you frame along, right? But it is also a very valid setup. It is a very valid way you can frame your buyers. Okay, so personally I don't like it, like I said, but it is very valid. Okay, so here we had a sell outside the Q zone, not valid. We had a sell here too outside the Q zone, not valid. Then we had a buy here inside the Q zone. Is it valid or not valid? This is not going to be valid. Why? Because at this moment what we are anticipating is a return into this gap. Okay, so until price gets to this gap, what we are going to be looking for is sell setups. Okay, so you can see from here again, price touch came back to the new week opening gap, right? And then we had a change in states of delivery somewhere here, right? So you could have gone short here, but if you are using the indicator, this is a sell. This is also not valid because it is outside the Q zone. Remember, after 12 o'clock typically you don't want to take any trade. So no trade on Monday, no trade on Tuesday, using this indicator anyways. Okay, if you have other ways, although you know, you could still configure this indicator to get a short. For example, if assuming I use let's say I use 5 minutes as my time frame. This is the older version of the indicator. Let me should I? Okay, let me remove this and use the latest version. Paradigm IMS. Is it? Okay. So I think this should be it. Yeah. Okay, so this is the latest version. If I change the time frame, okay, let's say I change the liquidity time frame to like say 15 minutes, and I use short-term high as my setup, you can see that you could still get it sell here. Okay, by default I'm using 1 hour time frame. Okay, maybe I'll make a separate video on the actual settings of the indicator. I don't want to cover it in this video, but basically different pairs would have different characteristics, so you will need to backtest and see which settings works best for your pair. Okay, for example, this current setting here is 15 minutes liquidity sweep. Okay, and then market structure shifts below a short-term low. Okay, personally for my EA, what I use is 60 minutes liquidity sweep, that's 1 hour liquidity sweep, and it uses intermediate time highs and lows instead of short-term highs and lows. Okay, so I'm gonna use the exact same settings I'm using for my EA. That's what I'm using, but it's going to be different across different pairs, so you might need to backtest and see the settings that works best for you. So for the sake of this video, I'm going to stick with this. So this is where we had the sell signal. Okay, this is the intermediate time low that I was taking, right? So you could take a sell here. So you could take a sell here. This is a fair value gap, price returning to the fair value gap, and you can place your stop loss, maybe above. This is an intermediate time high, right? So you could use that as your stop loss, or if you want to be very safe, you can just simply place it above the high of the day. The high or low of the day is the safest place you can place your stop loss, right? That's like the clear level where you know that then this trade you took is wrong, right? So, but let me use intermediate time highs. So for this, and then you are going to target the high of the new week opening gap, okay, where you are anticipating a return into. Okay, so this is a 2.74 hour trade. Okay, remember that this is actually not a valid short setup. If you are using the rule that setups that form outside the kill zone is not valid. Okay, so the EA, my private EA, would actually not have taken these shots. Okay, it would not have taken the shot. But if let's say you are using 15 minutes, you prefer to use the 15 minutes, and you see the sell signal somewhere here, that would be where you will go short. The stop loss can be above this intermediate time high or the high of the day, and you just simply target the low of the new week opening gap. But up until Wednesday, there is still no shorts for me. Okay, you can see on this day, this is third, this is shorts, this is a short setup, and my stop loss is always above the intermediate time high. So you see from here that if you try to go shorts, my stop loss will be here. I'll be looking to target this low. That to me would not be a valid trade because the RR is very, very small. Okay, but this happened during the kill zone, but the RR is not great, so I'm not going to take this sell. Okay, and this buy is not going to be valid because my bias is bearish until price gets into the new week opening gap. And this is also a sell. This is outside the kill zone as well, so I'm not also going to take this sell. Likewise, this outside the kill zone, this is a buy. Obviously, even if it is inside the kill zone, that would obviously not also be a valid setup. Okay, so the first valid trade was right here during this high impact news event. Okay, so I would go long here, right? And my stop loss could be somewhere below here. That's a lot of stop loss. Okay, my target is simply going to be the high, the low of the new week opening gap we marked out. That will be my first take profits, and my second take profits is going to be the high. Okay, so this will be the only valid trade that I'm going to take for that week. So that's I'm teaching you exactly as my EA trades. Okay, there is no, you don't have to trade exactly as I am trading, right? If you have a different entry technique, you can combine your entry technique with this approach to buyers to know when you should take your setup and when you should just do nothing. Okay, so you can see how price came into that new week opening gap. This is the first buy setup we are going to have, and I'm going to take it and I'm going to target that high. That will be all. That will be all that I'm going to do for that week. Just one trade for the whole of that week. Okay. So the next day, obviously, I'm already long, so I don't take pyramid entries, right? So all of this is a seek and destroy price action. So I'm just going to ignore that up until you can see how price keeps reacting to that new week opening gap. Okay, and the following week, Monday. Okay, so let me go back to the weekly. So we've seen what happened on the weekly time frame. The plan was to take a trade here and then target this guy. Okay, that was a 2 point something hour trade. So that week. So let's go to the next week. Okay, so let's assume we don't know what price is going to do the new week. Okay, the next weekly candle. So we want to mark out our charts. Okay, we want to see, okay, where is price going to where do we anticipate that price should return into, and where should we anticipate that, what should we target? Okay, so on this week, like we did previously, we want to mark out our new week opening gap. Many times the previous ones you've marked out would probably still be on your chart, so we know that this is still the fresh guy that we were anticipating that price will come into this week, but on this week it did not get there. So this next weekly candle is pretty simple and straightforward. What we are going to be anticipating is simply a continuation into this guy, and then when price gets to this guy, we can then perhaps frame a short setup. Okay, so this particular weekly candle is very straightforward because the previous week we already had an expectation of what to expect. So we already taken a trade somewhere here, so we just simply wait and see if price can get in here. Okay, now let me also chip this in. When you see this, when price is has moved away from a new week opening gap or an important price level, especially on the weekly or maybe daily time frame, and the drawn liquidity for that week was not reached, okay, the following week is typically going to be a Monday low of the week majority of the time. Let me repeat myself in case you didn't get what I just said. If price has just moved from an important price level, okay, like this new week opening gap that formed on this week, and if for whatever reason price did not get to your target, okay, you can see this is an inside bar. Okay, if price did not get to your target, you can anticipate that the following week is likely, okay, I don't know, but is likely, it's not all the time, but you can be sure that majority of the time that week is going to be a Monday low of the week. That is, the algorithm would be in a haste to quickly for that reach for that level that it is reaching for. Now I'm framing all of these around new week opening gap, but the same thing is applicable to other PD arrays. Okay, new week opening gap is what I have found to have the most accuracy of all the PD arrays, specifically for Euro USD. Okay, and that is why I am using the new week opening, and I'm talking to you based on data that I have actually backtested over the last 24 years. So I'm confidently telling you that I have backtested this, I've gathered the data for the past 24 years, and I can tell you that this works. Okay, majority of the time, I repeat myself again, if you frame your bias exactly as I have explained it here, you've marked your new week opening gap, right? You're anticipating a return into the new week opening gap, and you have the next new week opening gap that price has not yet returned into after a change in states. Once price leaves that new week opening gap, the algorithm does not get there that week. The following week, you would most likely typically have Monday low of the. That's when it's typically on those weeks you see how there is going to be, like, Monday is going to be a big win, just going to be in a hurry to quickly get there. Okay, so I thought I should chip that in, right? So the bias for this week, for the next weekly bar, is pretty simple. What we will be anticipating is basically an open, little retracements, and then we want to see price quickly expand to our initial targets. Now, if you get a buy setup that week, then you can take it. Okay, you're already taking your setup on this week. Perhaps you've moved your stop loss to break even, so it gives you room to take another trade. All right, so let me see what the low time frame is going to look like. Okay, before the low time frame, let's actually see the weekly candle. So let me play this so that we would see. Okay, I think that should have been painted. Ooh, wow, that's interesting. Okay, so let me go back and just close that. Okay, so this is we can see, the way the market was opened up on Monday, quickly rallied, to hit the targets, and even rallied above it, to reach for something else. Is there a guy here that it has not yet returned into? Yup. Okay, has it returned to this? Close below, yes, it has returned back to it. So on this week, our expectation, remember, at the start of the week, is based on previous week. This is basically what we are anticipating. We want to see price just reach for this guy, and then once price is above this area, we can then start looking for bearish setups. Okay, so let's look at the low time frame to see what it looks like. Okay, so this is Monday. You can see so we can actually take a trade here on Monday. We had a sell initially. Are we going to take this sell? Nope. Why? Because we are anticipating Monday low of the week. Why? Because the previous week we had a bias. We've built a narrative. price has bounced from the new week opening gap we are anticipating that it should bounce from, right? And then we had a target up here that we are expecting that price should reach for. And what is this target? This is a new week opening gap that had a change of state and price has never returned back into. Okay, so we know that at the start of this week we will be looking for a long. Okay, so this is an opportunity. This is the first buy signal we had at the close of that candle. So you could go long immediately. You had that buy signal, place your stop loss at the most recent intermediate time low, which will be this guy, or you can also use the low of the day. My EA switches between intermediate time low and the low of the day depending on the RR. Okay, the RR, its targets is RR that are greater than 2. Okay, 2 and above. Okay, so if the RR is not going to be up to 2, it is going to use the closest intermediate time low. Okay, if the RR is not if the RR is less than 2, it is going to use the closest intermediate time low, which will be this guy. But typically it uses the low or high of the day. It all depends on how wide the range between the confirmation price and the low of the day, how wide the range is. If it is too high, then to try to reduce the range to the closest intermediate time low. Alright, so on this week, on Monday we had a buy, so we are going to target the low or the high. You can first take some profit at the low and then take your last profit at the high. So we can see on this day how price failed to get to this area and then reversed. This is a high impact news event. What time is this? 8:30. Yeah, so this is an 8:30 news event. You can see this is also a buy. On this day, if you had, this is why I don't like taking pyramid entries on the same week. Okay, you can see that if you had gone long here, no, it doesn't mean you shouldn't do it. Okay, it's just something I don't like doing. Right, if you had gone long here and you place your stop loss, this is the closest. Is this an intermediate time low? Oh yeah, this is an intermediate time low. No, this is not an intermediate time low. This is actually not an intermediate time low. This is where the intermediate time low is. So this is where you would have placed your stop loss, and obviously you would have been stopped out. Okay, but you could also re-enter after you've been stopped out. Alright, personally I don't take pyramid entries. I take only one setup per week. Not like per week, like I take one setup as long as I haven't break even. Okay, and I only break even if price is very much away from my entry. Okay, maybe like after a day or two and price is very much away from my entry, that is when I break even, and that is when I can then take a pyramid entry. Okay, but most times I don't take pyramid entries. Okay, so on this week, let's say you want to take this, that is where you had to buy. Remember, your stop loss can be the low of the day or the most recent intermediate time low. Alright, that has not been taken. Okay, an intermediate time low that has not been taken, because typically when price comes to that intermediate time low for the first time, it will struggle to close below it. Okay, so let's assume that you were stopped out the first trade here. This is another buy at the close of this candle. You could still go long, and then maybe just place your stop loss below the low of the day again, and then if you target the low, the RR would be too small. That's 9. That's like 1R, 1.4. This is not going to be a valid trade for this day. Alright, So the moment price comes into this area, your bias is going to switch bearish. Ideally, you don't want to do anything, you don't want to take any long again, you don't want to even take short setup until maybe like towards the end of the week. Okay, so on this day, remember, the moment price has filled it, your bias is going to become bearish. All right, so yes, this would be a valid trade for me personally. I'm going to take this shot, okay, because this is a fresh new week opening gap. I would be anticipating that the first return into it, ideally, I would want to see price close above it at the end of the week. Okay, so I would have probably taken this shot. Oh, not valid. This is outside the Q zone. What time is this? This is 6:40. You can see how trades that form outside the Q zone typically would lead to a stop out. Assuming this is not outside the Q zone, this is a trade that I would have taken, because this is a fresh new week opening gap. Once price is inside the gap or above the gap, then I want to start looking for a sell. But here we had a buy. This is a valid buy. You could take it. My EA would have taken this based on a different concept. Okay, the idea that once price is up at the start of the week, and price on Wednesday, the price is currently above the opening price, there is a high probability that price will continue up until at least Thursday. Okay, so my EA would have taken this buy, and also based on the daily approach that I taught you. Remember, I mentioned in that video that it is going to go back in time and check if price takes liquidity below the previous day's low, and the previous day's low can either be midnight New York time, or it can be 5 p.m. New York time. So on this day, this is 12 midnight New York time. So this is the low of this day using that time frame. So you can see that this day has taken liquidity below this low. So, and the price at which the setup formed is above the previous day's low. If you don't understand what I just explained, please check out the previous video. I explained that. Okay, but I don't want to chip everything in at the same time, because so that it doesn't get confusing. I want to just focus on the new week opening gap. Okay, so based on the concepts of the new week opening gap, this sell would not be a valid sell because it is outside the Q zone. This buy, based on the new week opening gap, you wouldn't want to take it. Okay, but based on the daily approach, this would be a buy setup. Remember, I mentioned that you are combining the two together. Okay, but you can just ignore it, because you would be anticipating that by the end of the week, ideally the market should not close above it. Okay, if we are in a sell program. Okay, but in this case we are still in a buy program, but just to be safe, you can just ignore it and not take the long. All right, and on this day, this is where we had a sell. Okay, this is where we had a sell. This, what time is this? This is 2, so it is during the Q zone. Okay, it is during the Q zone, so this would be a valid sell setup. Why? Let me go back to the weekly time frame and show you. Remember that on this week we've marked out this guy. This is the first return into the new week opening gap, so we are anticipating that ideally the first return into a new week opening gap should ideally not close above it. We don't know if it is going to close above it or not. Okay, you are simply following what price is going to do. All right, at the start of the week, remember, our plan is, okay, we just want to see price rally up and come back into this area. Okay, if you are conservative, the moment price hits the high, you could just sit out the rest of the week and not do anything else. Okay, you've taken one trade this week that hit its target. You've taken one trade on Monday, valid trade on Monday that has also hit its targets, and that's how many are. The first trade was about 2 point something R. The Monday trade was like how many R? This is a 5-hour trade. Okay, yeah, so this is a 5-hour trade, so that's, on a norm, that's enough for the week. All right, that's enough. You could just sit out and say that, okay, you're already done by Wednesday. When did you hit the high? This is when it hits the high. So you could just simply say you're already done on Wednesday. You don't really care what price is going to do again, and just simply sit it out. Okay, but if you want to, you want to continue to follow the approach that I explained, you can see that while prices are above this area now, our bias is going to be bearish. So you could simply take a short here, and what will you target? Okay, so let's look for our targets on the weekly. All right, so remember that we don't know, maybe somewhere around here, that's when we had this sell setup. That is on Thursday we had this sell setup. So where would you target? You can just simply target the most recent liquidity, the most recent new week opening gap that price has closed above, and initially that would be this guy. Okay, that would be this area, this guy. So this is what you would want to target initially, okay, until you have new information at the close of the week. So what you would do is, once you take your trade, this is where we had a short confirmation. So your stop loss is going to be above the intermediate time high. That will be this guy, or above the high of the day. That will be that guy. Remember, this is a typical example of the daily and the weekly approach aligning together. Okay, because this day's high is greater than this day's high, and the price at which you got your confirmation setup is also below the previous day's high. That was what I taught in last week's video. So you see it repeating here, and the bias is also bearish at this point in time. Why? Because price is above this new week opening gap, and price has never returned into it. So while price is above this area, you are anticipating that we should not close below it. We should not close above it rather. So we don't know that this week's bar is going to close up, but we don't know yet. So you don't know what price is going to do, but you just want to follow the same process over and over and over again. So if you go to the low time frame on Thursday of this week, we see that prices are way above that new week opening gap. So above here, you are going to be looking for what? For a short. So you know that all of this buy, you are not going to take them. Okay, this is a buy here. It is inside the Q zone, but it is not going to be valid. Why? Because your bias is now going to be bearish for two reasons. One, the daily approach I taught you guys in the second video of this series. You see it playing out here because the high of the day is greater than the previous day's high, and the price at which you got your confirmation is below the previous day's high. If we use 5 p.m. New York time. Now remember, you can either use 5 p.m. New York time to demarcate the start of a new day, or you use 12 midnight New York time. So you can either use this or use this, right? I combine both. So either of them, if any of them is true, I would I could just use any of them. Okay, so what will you target? Remember, this is what we are going to be targeting, this guy here, because this is the closest new week opening gap that price has not yet returned into. That is this guy right here. See this guy? Is it this guy? No, this guy. Oh, not this, not this, not this, not this. This guy. So that is what you would want to target initially. Okay, so I'm going to just draw it. So this is what you are going to target initially. You want to target the high. Sometimes, you know, it is going to bounce from the high, sometimes it will bounce from the middle, sometimes it will completely fill it, sometimes it will even drop lower before it then bounce. Okay, so this is how you are going to think. Okay, I'm trying to give you the step-by-step approach to how to do this. Okay, so initially that is what you are going to target. This is like it's our trade, right? So then you wait till this is Friday, price closed somewhere here on Friday. Okay, on Friday. So let's go back to the weekly time frame and let's try to frame our buyers for the following week. So on this week, remember, you want to check, okay, as price recently closed above a new week opening gap, right? Has there been a change in states of a new week opening gap? So you can see this guy that we marked out initially, that we said that the first return into the new week opening gap ideally should not close above it. Okay, the time that you would have price close above it is typically when the order flow is bullish. You can see from here that the order flow has been bullish, right? But it still doesn't mean you can't take a short. Still doesn't mean you can, you know, because you don't know if at the end of this week price is going to close above it or not. So we took a short right here, right, and then we wait to see how the week is going to close, and here we saw that we had a close above it. So what, and remember, we were targeting this area because before the close of this week's candle, this was the closest guy that price has not even this should be this guy. So we even targeted the wrong guy because price has already returned into this, although it did not completely fill it. So you could maybe target the low, but ideally you want to target a fresh guy, a fresh new week opening gap that price has not yet returned into. That would be this guy, because we marked it out here. After price has closed above here, we have not yet gotten a return back into it. So this ideally, if we went short, say this would have been what we would have targeted initially. Okay, remember, you always want to pay attention to what price is currently doing. So at the end of this week, we see that we have gotten a close above this guy and we've gotten a close above this guy. So would you still be targeting this area? No, you're going to adjust your target to this guy. So how do we now build our buyers for this current week? As usual, we are going to mark out the area, the new week opening gap that has just had a change in state. This guy has had a change in state. This one we marked out here. Price has closed above it. Okay, there is also a tiny little new week opening gap somewhere here. Should we use it? There is also another one somewhere here. Okay, so whichever one you decide to use, this is a new week. Remember, I said you can always use anyone. This is very tiny, right? But it is right there. Very tiny, but it is right there. Okay, so this is a new week opening gap. Price has closed above this guy, and there is also one here. Price has closed, so let me extend that out in time. This is what you do every week. Okay, so this is a new week opening gap right here. The price has just closed above, so we have this guy, we have this guy, we have this guy, and we have this guy. Okay, all of them had just had a change in states. So now we have 1 2 3 4, we have 4 new week opening gap that we could use to frame our buyers for this week. Okay, so remember the other flow is bullish. Okay, and the price had already had a change in states of all of these guys. So what we'll be anticipating for this current week is we want to see a return into this first guy, or this guy, or this guy, or this guy, and then we will be looking to take a long. Okay, so our initial bias is going to be bearish until price gets to this area. Okay, or this area, or this area, or this area. So how do we know which one to use? Remember, I explained earlier, just take your fib, find the midpoint between the high and the low of the current weekly candle. Look for 50%. This is 50%. Below equilibrium is discount, above equilibrium is premium. So you want to look for new week opening gap that is below premium. Okay, this guy is at premium, so we don't want to use this guy. Okay, so I can just remove that, since that would not be valid. Now it doesn't mean it's not valid. Okay, the algorithm would still see this as a valid new week opening gap. So I'm curious to see what is going to happen here. Ideally, the next weekly candle should ideally still not close below it. Okay, but when you have multiple options like this, the easiest way you can just filter out which one to use is just by removing the ones that are above equilibrium. So let me just delete this. This guy is at equilibrium. Okay, but let's just follow the same approach. You could use this since it is slightly below equilibrium, but because the high of the gap is above equilibrium, that means if I want to frame a long, I would want to target either the midpoint of the gap or the low of the gap. But let's use the low of the gap. Okay, this I'm telling you exactly how I'm thinking, how I'm going to be thinking when I'm trading that week. Okay, so I will be looking for price to completely fill this new week opening gap. This is one of the ways you know if price is going to completely fill it or is going to bounce from the middle. For example, here now I would be anticipating a complete fill. Why? Because this guy is just at equilibrium, and the algorithm basically likes to drive price to discount before it reverses. So this is the third one. It's very tiny, but it is right there. So the most ideal one would probably be this and this, because they are way below equilibrium. Okay, but it doesn't mean that this is not valid, or the one I deleted, the one I removed, is not valid. But I will start looking for a long the moment price fills this guy completely. And at the start of the week, my bias initially will be shorts. Okay, if I get a short setup, I will take it, and I want to take my profit once price hits this area, not the high in this case. Okay, so that would be my narrative going into the. Remember, we took a short here, so which is still running. Okay, so that means for this week I would want to adjust my targets to the low of this new week opening gap right here, because we already had a change in states here. So I'll be looking for a return into the low of this new week opening gap. That would be my expectation going into the week. Okay, so let's see what price actually did for that week. Okay, so very pretty simple. I want to see price drop below, right? I want to see drop into this area, and then once price go below this area, I would want to take a long to target the closest new week opening gap that price has not yet returned back into. So in this case, so let's look for our potential targets. This is a new week opening gap here. Price has already returned back into it here and rejected. So this is also a new week opening gap here. Price has already returned back to it on this week and rejected. This is another new week opening gap. Price has returned and rejected. This is another one here. Price has already returned to it here. So all these guys. So this would be the only new week opening gap that price has not yet returned into. So this for me would be what I will be targeting. That's really far from current price action, but that's pretty much how my EA works. That is what it is going to be targeting. Okay, because this is the only new week opening gap. All of here, every other new week opening gap, you can see that price is returned to every single new week opening gap that formed. So that should further corroborate the idea that there is a 70% chance that when price forms a new week opening gap, there will be a return in. So you can see that every new week opening gap that formed as far back as 24th of January, as far back as 24th of January, price had returned to all of them with the exception of one. That is sick, guys. Okay, if you understand this and you try to integrate it into your trading model, I promise you are going to see a big shift in your profitability. Okay, the number of losing trades you are going to have is going to drastically reduce, I promise you. All right, so yeah, so that's our expectation for the week. Now let me play the bar and let's see what is going to happen. Okay, so I'm getting a drop. It closed below it. Did it? Exactly. Okay. Right. So this stuff is just like magic. To be honest, it's just like magic to me. You know, when I first discovered this and nobody taught me this, I did not see this in any book, I did not watch this in any video. I discovered this simply by backtesting. Okay, the way I got to know about this was I was looking for the highest probability ICT PD array that I can use to frame my buyers on the weekly time frame. Okay, and I started with the other blocks. I looked at new week opening gap, I looked at vacuum block, fair value gaps, I looked at pretty much every single ICT PD array that I knew, and I automated the back test. So I checked as far back as the last 24 years to see which one has the highest probability. So I wrote a script and I ran it over every single week for the last 24 years, and I checked the results. I saw that the new week opening gap for Euro USD specifically has the highest probability. Okay, that once price return into it, is going to reject. Okay, so yeah, that said, so let's go into low time frame and see how you could have traded this week. This is 20th, 24th of Monday 20. Oh, this is Monday 20. Okay, so this was the initial trade that we took last week. Okay, so that means on Monday we are anticipating. Remember, your initial bias is going to be bearish until price gets into that new week opening gap, and the new week opening gap we said was high probability was this one, and we said we would want to see price get to the equilibrium, which will be the low of this new week opening gap. So that means we would have to adjust the trade to the low of the new week opening gap. That will be right here. So that would be a 3-hour trade. Once it hits the low, we get out. Okay, let's see if there is any trade that formed on Monday. So you can see on Monday we had a sell. Okay, and we see the same concepts that played out here. Price is above the high of the previous day. This is demarcation of the previous day if we use 5 p.m. New York time, right? So you can see that the high of this current day is greater than this previous day, and the price at which the sell-off formed is below the previous day's high. So the daily approach in this case here is bearish, and we are also bearish when we use the weekly approach I taught in the first week. You can see both approach here are aligning. Okay, so we are going to take our shots here. You can see the sell signal that formed right there. So we're going to go shorts. Stop loss is going to be above that high, and you are simply going to target. Remember what our target is. This is where we are anticipating that price should come into. So Monday, that is a 4.63 hour trade. On Monday, this is a buy. What time is this? This formed around 3 a.m. New York time. You can see how the good setup typically form inside the kill zone. This is another day we had a buy here. Would you take this buy? No. Why? Because we are currently bearish until price gets into that new week opening gap. Okay, and so we have another short setup here. This is 8:30 New York time. So you could also take that short, right? Stop loss above the closest intermediate time high. So this is intermediate time high, pretty much similar setup to the previous day, and your target is going to be the new week opening gap we marked out on the weekly time frame. So this is 2.5 hours, so that's valid trade. On this day we had this buy during Asia session or Asia Q zone. We don't trade during Asia. This is a sell. Bias is bearish, but we don't trade during Asia, right? And on this day we have a buy. Okay, that means we are going to ignore it because our bias is what? The bias is bearish. Okay, so, and we are already even short here anyways. Normally I would not have taken this sell setup because I was already short from Monday. Okay, but if you are the type that likes to pyramid into trade, because one thing here is the thing, once you get one good setup, every other setup that presents itself, oftentimes the algorithm will try to use it as liquidity. Okay, that is why I don't like to pyramid, except price is way far away from my initial entry. So I want to break even first before I can take the setup. Although even if you had broken even here, price would not still have taking you out. So but I'm very conservative with my trading. So personally I would not have taken this trade simply because I don't like to pyramid close to each other. Okay, I only pyramid when I know that I'm absolutely certain that price would not come back to take me out. Okay, so you're going to ignore this buy. Of course, this is Wednesday. You're going to ignore the buy, and then we had a sell here. This is outside the Q zone, so that is not a valid sell. Remember, look at, if you are taking this sell, this is not even valid because price is already even inside the new week opening gap we were targeting. Okay, so once price goes below here, we want to start looking for a long. Okay, and on Thursday we had the first buy here, okay, which would have been a valid long, but it is outside the kill zone. Notice how, and if you are taking this, you would have been stopped out. This is where we have, this is intermediate term low. If you are using that as your stop loss or the low of the day here, and you would have been stopped out irrespective of which one you use. See why, taking only setups that form inside the kill zone, how extremely important it is. So this is a buy. If it wasn't outside the kill zone, it would have been a valid buy. All right, it would have been a valid buy setup. Okay, so we had a sell here. Obviously this is not going to be a valid sell, right? And we had a buy here. Okay, this is a second new week opening gap. We mentioned that is more high probability. Price has filled the low, so here we had a buy. So this is going to be, we're going to go long right there, stop loss at the low of the day. And what are we going to target? Our target is far up. Okay, that is what you are going to anticipate. Okay, that is what you will target until the close of the week. Okay, at the close of the week, you can now reevaluate, or let's at the start of the next week, you can now reevaluate and see, okay, where do you target? This is Friday. So our initial target was up above. So I'm just going to say here. And if you are the conservative type, you can just simply close towards the end of the towards the close of the week. Okay, at the close on Friday, this is like 4-hour trade. Let's say you close it somewhere here, that's like 4-hour trade. Okay, so but the way my EA trade, it doesn't close it on Friday. It's going to reevaluate at the end of the week, or sorry, at the start of the new week. Okay, it's going to check, did the previous week close below a new week opening gap? Then if it does, it is going to adjust the take profits to that new week opening gap. So that is how this week, how you would have traded this week. Monday, this is like a 4.6 hour trade. This one is like 2.5 hour trade, and this would be up about, let's say roughly 4 hour by the end of the week. So 4 plus 4.6 plus 2, that is roughly more than 10 hour in 1 week. Okay, so let's go back to the weekly and do our analysis for the next week. Okay, this is one that I marked. This is one that I traded on my on a challenge that I'm currently taking with my funded FX. Okay, so at the start of this week, you want to mark out your new week opening gap. Okay, we have this new week opening gap right there. So I'm going to mark, let me use it what I use normally. Let me just use that. Okay, so the first thing, remember, you want to mark out your new week opening gap at the start of the week. If there is a new week opening gap that has just formed, you want to mark it at the start of the week, especially if it is significant enough, okay, or close to current price action. Okay, so the closest new week opening gap that price has not yet returned into above current market price is this guy right here. So you want to mark it and extend it out in time. And the closest new week opening gap here that price has not yet returned into is this guy right here. Price has returned to this one, but it did not return to this one. Okay, there was another one we marked somewhere here that I removed. Price has returned to it now, so we don't deal with those. Okay, the closest is this one. Okay, so what is our bias going to be for this week? Our bias is going to be bearish until we get into this guy. All right, why? Because this week has closed below this new week opening gap. So we already have a change in states from from bullish to bearish. Okay, remember I mentioned that a new week opening gap is confirmed initially bearish if we close below the new week opening gap at the end of the week. Okay, so remember we took a short. Was it a short? A long rather. We took a long somewhere here at the close of towards the close of the week, I think on Friday, and our initial target was this guy here. Okay, but at the end of the week we saw that price has now closed below this new week opening gap, so we are going to adjust our targets to this new week opening gap that we marked here. So let's go there, and this is it right here. This is the new week opening gap that formed at the starts of the week that price closed below. Okay, this new week opening gap formed at the starts of the week, somewhere here, I guess. Yeah, somewhere here. So I posted this. Yeah, was it this? Yeah, I think I posted this on my Telegram channel where I was showing you guys that this thing repeats week in and week out. All right, I marked it at the start of the week. I was anticipating that once we get a rally above this area, I want to see a short, and I want to target this new week opening gap that price has not yet returned into. So if I come, so that's our expectation for the week. This is a new week opening gap. I want to see a rally above this area because we already have a change in state right here. So we want to see a rally above this area. So once we are bullish, don't forget we are bullish until price gets here. Okay, so bullish until price gets here. Immediately price gets here or above this area, bias is going to be bearish, and then we are going to remain bearish until price gets to this area. And the moment price gets to this area, our bias is going to become bullish. Okay, so expectation rally above this area. Expectation, I want to say returning to this area, then bearish, or you want to first see a drop into this area, then long to target this area. So it can happen either ways. Okay, just have to be open to see whatever it is the market is going to do. So the next weekly candle can either first just open up, start dropping, come here, then start running from here to come back here, or even above here. So you don't know which one it is going to do. Okay, so you just want to build the narrative of what you can expect, where you want to be bullish, where you want to be bearish. So in this case now, I want to repeat myself. We're going to be bearish anywhere inside of this new week opening gap or above it. Okay, you want to be bullish until price gets into it. So you could actually even take a long from around here until price gets here, right? But personally, like I said, I don't like to do that. I prefer to see price come into a fresh new week opening gap that price has never returned into to frame my setup. Okay, or you can also be bearish till price gets here. Okay, and then look for a long to target this area. So you don't know in which you don't know which one will come first. Okay, but remember that price bounced from this guy this week, so typically it would want, before it reverses, it would want to reach for another new week opening gap. Okay, so personally for me, I would rather expect or anticipate that price should come to this new week opening gap first, and then reject from there to come back into this area, and then I can then frame a long from this area to target the next untested new week opening gap, which would still be this guy. Okay, so let's see what price did that week. So I'm going to click on this. Oops, That's quite interesting. Is that all? Where is the next week? Oh, I think this should be the last candle. Is it? Today's what? Oh yeah, this is the last weekly candle. Okay, so I can just simply close this since that is the last one. So now let's see. Now it's not easy to tell which one happened first. We don't know if it came down and then went up. So let's just go to the low time frame. So this is Monday. Remember, we were long from the previous Friday. So and we adjusted the targets to this new week opening gap that formed the previous week. Okay, so this would be our target. On Monday, you could still have taken a long here on Monday, okay, to target the new week opening gap. This is a long. Let's say you go long here, long. Your stop loss is always going to be the most recent intermediate time low or the low of the day. Okay, so let's say I use the low of the day will be this area here. So, and if you are using 12 a.m. New York time, this is going to be the low of the day. So the algorithm refers to both of them. It switches between the two. It's like a kind of it's like a system where they don't want you to be able to always guess which one it is going to use. So the algorithm can use anyone. Alright. So you target the new week opening gap. You can target the low or the high. Okay, if it is very tiny like this one, you can just simply target the high. But most of the time, I always like to take something off immediately it touches the high, and then it touches the low, and then once it fills it completely, I close everything. So this is like a 2 point, roughly 3 hour trade for Monday. Once it hits it, your bias is going to immediately switch bearish. Okay, so we had a short here. This is the shorts. That's the close of this candle. So personally, I would be anticipating a return to fill this new week. Most of the time, my EA personally, the way my EA trades is going to take the shorts immediately at the close of this candle. Okay, but personally, if I'm trading manually, I would want to see price return back into this area, then I'll take my shots. So let's say this is the EA trading now. It's going to go short here, and stop loss is either going to be at the intermediate time high, which should be this guy. Is this an intermediate time? No, that will be this guy. So that will be that high, and it is going to target the, that will be this guy, I guess. That will be this guy. This is what 1.07893. This guy. Yeah, so this guy, that is this guy here. Okay, so that is what it is going to target. So it's just going to go short immediately at the close. It doesn't wait for retracements. Okay, but personally, I might want to see if price will come here. All right, so the next day, which is Tuesday, price took it out, stop out. So that would be a losing trade. Okay, is this inside the Q zone? Yes, this is inside the Q zone. So this is a valid loss. Okay, I think this should be the first valid loss that we are going to have since I started for the past 5 weeks, right? And the next day we have a short here. We have relative equal high. Now, normally you don't take trades below relative equal highs. If there's a relative equal high like this, it's generally best to avoid it. Okay, but you can still take it if you want to, because not every time price is going to come back to take out the relative equal high. And I haven't built the idea of checking for relative equal highs into my EA, so right now it doesn't check for relative equal high. It would have taken this trade and it would have been a loss. Okay, so this would have been a loss. It will still target the same thing. Okay, stop loss, that's a valid loss, right? Remember, bias is going to be what? Bearish. The plan is that once price goes above the new week opening gap, that is this guy right here, this guy here is this guy here. So the plan was that if we get a rally above this area, our bias is going to be bearish and we want to target a new week opening gap that price has not yet returned into, which will be this guy right here. Okay, so we had a buy here. Obviously you know you are going to ignore the buy. Okay, that would not be a valid buy. And then we had a sell here, so that would be your shorts, and then your stop loss is going to be above an intermediate time high. So this is an intermediate time high right there, or you use the high of the day. Okay, so if you are using intermediate time high or the high of the day, whichever one you use, you would still not have been stopped out. So I want to use, let me use this intermediate time high simply because it is above this liquidity that I was taking. So personally, if I was trading manually, that is what I would have used. I would have used the intermediate time high, because ideally you would not expect that price should come back there again. All right. And there's another reason. This is also a balanced price range. So typically, remember what I explained on the daily the other time about the balanced price range. This range in price from this high to this low is a balanced price range. Why? Because price has provided sell side, provided buy side, and they moved away to close below it. So typically, if you get a return to it, the Algo will reject. Okay, so you can see how it came back, reject, came back, reject, came back, reject, and came close to it and instantly rejected. So I would be confident to place my stop loss here. Okay, maybe in another video I'm going to do a detailed explanation of the concepts of balanced price range. All right, so we are going to go short right there, and we are going to target this guy that price has never returned into, which would be this guy right here. Okay, so that's the first trade which happened on, oh, that's when we had a, that's right there, stop loss is there. So let me see. So again, targets the high. Okay, I'm gonna use the high. That's where I will at least take like maybe 80%, 90% off, and then once it fills it completely, I close it. Alright, so that would have been an 11-hour trade. 11-hour trade in 1 week. And if you had used the high of the day as your stop loss, this would have been a 5-hour trade for that week. Alright, so the next day we have a sell. Okay, so you could just go short right there. Your stop loss is above the intermediate time high, which is this guy here. So your stop loss will be above that guy. This thing is looking to, I want to hide the short term highs to show just the intermediate time highs. Okay, so I think, let me hide these guys too. Okay, so I think that's cleaner. So you could go short immediately at the close of the confirmation candle where you had a sell. remember the buy, you are going to ignore it. Okay, you are going to ignore it because your bias is bearish until price gets to that area in price. Okay, here it was very close to getting stopped out if you had used the intermediate time high as your stop loss. If you use the high of the day, that is where your stop loss is going to be. Okay, so you would not have been stopped out. Or, if I'm trading manually, personally, I want to see if price is going to maybe fill this liquidity void, this imbalance we have here. So that could have reduced your stop loss, okay, to increase your RR. So your bias is going to be bearish, and this is another sell. So if you are going short here, is inside the Q zone. This is 1020. Is this one inside the Q zone? Yes, inside the Q zone. And this is also inside the Q zone. So you could also have gone short there. Your stop loss will be above the intermediate time high. Okay, the indicator also shows intermediate time highs. These guys, these are the intermediate time highs. Okay, so we have a buy here. This is outside the Q zone, and our bias is not bullish yet until price touches the new week opening gap. So this is where price touched the new week opening gap. Okay, this new week opening gap right here, this is the same one. This is the same one we marked out here. Okay, and I hope you can recall why we are using this. This is the closest new week opening gap that price has not yet returned into after we had a change of states on this week. Okay, so it touched the low, so that is where you are going to exit majority of your shorts. Okay, personally, I like to leave like maybe 10% to see if it will actually completely fill it. So in this case, it did not completely fill it. So the expectation, and we had a buy. Okay, this is during the Q zone. You can see 3 o'clock during the Q zone. So if you go long immediately, you have your confirmation. This is the intermediate time low. You can place your stop loss right there, or you place it right here. And remember, what do you want to target? You want to target the a new week opening gap that is above it, or considering the fact that we know that at the start of the week, remember this was the new week opening gap we frame our long run. Remember we said anything above this area bias is going to be what? Bearish. So you can just simply target the new week opening gap, or just use this area as your initial targets. Okay, that's this guy here. You can make that your initial target until the end of the week to see what you should target. Okay, or you can just simply use the new week opening gap. Remember, the idea is above this area bias is bearish, so ideally this would be a really nice and decent target. Okay, so because you know that by the end of the week, you don't expect that price will close above it. Okay, so rallied above it and then instantly rejected to close back below it. So that's pretty much what you are going to be looking at the start of the week. We had let's say 2 losses. Let's say we did not consider this equal high and we took these shots. That would have been 2 losses, 1, 2, 3 wins. And this first trade is 5R. This second trade, let's say we waited for the liquidity void to fill. This would be 5 hour, another 5 hour trade, and this one, if we targeted this area to close the long, this would have been a 5.7 hour trade. If you sum them together, this is like 15-hour trade in 1 week using this approach that I've taught you. You can see it repeats week in, week out. Okay, this is the specific algorithm I built into the EA that I'm currently using to trade, and the EA has been profitable over the last 24 years. Okay, the total return over the last 24 years based on backtest is over close to 4,000% return. That's an average return of about 65% every year. Okay, last year it did about over 200%. Last year was the highest over the last 24 years. So last year was really good. This year so far it is up about roughly about 28-30%. Now, a lot of this trade example that I showed here, there are a number of filters I use. So some of them it is going to miss out on them. Okay, there are a number of filters that I used. So it's not all the valid setup that we took care that the year would have taken. Okay, for example, it doesn't trade on days there is a high impact news event. Okay, so we did not consider high impact news event throughout all of the examples we looked at. So that reduces its profitability a little bit, but when you look at it over several years, you realize that it is just better off not trading the high impact news event. But if you are trading manually, as long as you have your setup, it is inside the kill zone, it is in alignment with your bias, then it's valid. Okay, so that's pretty much the you can also see here we had another buy setup. This is where your stop loss is going to be. Is this inside the kill zone? Yes, inside the kill zone. Obviously you are going to ignore this sell setup because your bias is now bullish, because price has returned into this new week opening gap that it had never returned into. So that at the end of the week the price should be way above this area. So I hope you find this helpful. Maybe I will start creating a kind of like a weekly outlook video, to help you guys mark out the new week opening gap to work with, or what you can anticipate for the week. Or perhaps I'll make it a weekly review, that is after at the end of the week I can make a quick review of how you could have traded using this indicator that I provided, combined with the understanding of the new week opening gap concepts and the daily approach. I also explained to you guys. I didn't emphasize much on the daily bias approach, but it repeats. When you check it, you see that it repeats. You can see this day, if you use 12 a.m. New York time, you can see that this would be the high of the day. That Asia high would be the high of the day, of the previous day, and you can see price is above the day's high, is above the previous day's high, and the price at which the seller formed is below the previous day's high. So you can see that is true. So even if you did not use the daily approach and same thing happened here, price has taken the previous day's high and closed back below it. That's the setup, that's your current price, that's the price at which the setup formed. Okay, so that would be true for the daily. And you can see how oftentimes the daily is usually in alignment with the weekly approach I taught you guys. Same thing happened here. If you use 5 p.m. New York time, this is the previous day's low. Price took the previous day's low. The confirmation price is above the previous day's low. So that is true. So your bias is bullish even on the daily, right? And if you used 12 midnight New York time, same thing would have been true, because Asia low would be the low of the previous day, and the current day are taking the previous day's low, and the confirmation price is above the previous day's low. So that would be true as well. My EA uses both of them. It uses both of the rules. It combines them. There is a specific sequence. There is a specific set of instructions it uses to know which, new week opening gap to use. But I've pretty much taught you most of it, right? I hope you find this useful. Maybe I will resume the weekly outlook video soon, or the weekly review. It will be one of them. I don't think I would want to be making. I have the time to make the two. So let me know which one you would prefer in the comment section. Would you prefer I do an outlook, like an expectation of what we expect, or do a weekly review of what has happened that week and how you could have traded using this indicator and what I have taught you? All right guys, I would see you guys in the next video.